If you're a high earner 10 years from retirement with serious money building in your retirement fund, this episode is for you. Should you invest or pay off debt? Most people get this question completely backwards. Go online, ask on a forum, or read a finance book, and you will get very confident answers. The problem is that it is almost never based on your circumstances. It's based on someone else's rule of thumb, usually from a country with very different interest rates, tax laws, and retirement regulations. In this episode, Pieter and I are going to show you how we actually think through this dilemma with our clients. We're also going to show you that the most obvious answer is often the wrong one. Something that our clients often come to us asking is, do I invest all the money that I have available every month after paying off all the bills and everything? Or do I settle my debt? Invest or settle debt? It's a very common question, and it's often seen as a binary thing. Like, should I spend all the money on my bond, or should I spend all the money on an ETF? And so today we're going to go into that, kind of give you an idea of how we think through this problem and how we look to solve it with the clients that we serve. So Pieter, I want to hand over to you quickly. Just please give us an idea of why you think our clients always come to us with this question. Why does it pop up the whole time?
Thanks, Bryan. So we typically work with people that are about 10 to 15 years away from retirement, and they're in a very special type stage of life where they are realizing now retirement is getting closer. They're probably at a point where most of the kids are close to getting out of the house, so a lot of their cash flow went into just getting them through school and university, and now they are probably at that point where they have some cash flow opening up from maybe school fees that they can now redirect, and they need to decide, do I invest or do I pay off debt? And most likely they still have a bond on their primary residence, maybe an investment property or two. So the question comes, do I accelerate the debt payments on my bond to smash that up earlier so that I can be debt free and then reallocate everything to investing? Or do I do a bit of both, the best of both? Do I invest and pay off bond? Because when you go online, you'll get two schools of thought, and usually there are very strong opinions on both ends. There are some people that says just pay off all debt is bad, just get rid of it, you don't want to owe anyone anything. And then there's the people that says, paying off debt is great, but investing might actually lead to better long-term outcomes. There's an opportunity cost of not investing our money in the market. And just like anything with personal finance, it's personal, it's situational, dependent. There's not a right or a wrong, like you can only do it like this. It's depending on your situation and what you have to think about. So today, that is what we're going to unpack. It's just a few factors that we typically see our clients come to us, questions that they ask, and then we're going to share the frameworks that we follow to help them understand which direction might be the best outcome for their situation.
Yeah. No, cool. Thanks. And that sums up pretty neatly the thinking generally in society. Like you said, people say, debt is bad, so you must settle it, and investing is good, and you must do that once all your debt is settled. And the problem you have is that you got a 20-year bond maybe. So you say, fine, let me accelerate the payments on that 20-year bond, bond being a home loan. Now, do I not invest for that period? Do I not put the money away for the future? What if during the payment period or repayment period, something happens to me and I can't work anymore or whatever? I need to have money available. So the first thing in financial planning in general or personal finance is that you can do two things at once. You can settle debt and you can invest. There aren't absolute kind of decisions that you would generally make in finance. There aren't always those decisions. You can do two things at once. But when we talk about debt, settle debt versus invest, I think it's important just to clarify what debt we're talking about. Now, you get the debt that we all kind of used to, where you buy a house and you now finance that house and you got to pay it off over whatever term. Even super wealthy people that we deal with, they will do that because, they buy the house that, maybe it's going to cost, 10 million or something. And at the time they had 3 or 4 million that they could put into it, but they've still got a sizable, like a chunky bond that's remaining. Very common to finance properties. So that's the first thing. The other thing is a car, financing a car. The interest rates on a car are not too bad. And so it's because there's an asset underneath it that the bank can take back if you don't pay. So you get your house, get a car. There might be financing an investment property. So a rental property, an apartment or whatever you bought, a beach house that you're renting out. That's another consideration, and it's treated differently, and we'll get to that just now. But then you get short-term debt. So short-term debt is normally unsecured debt. It's not backed to buy an asset. It's like a credit card or an overdraft. And I mean, Pieter, I know you've done videos on this before on money marks, but you're gonna pay ridiculous like interest on the. I mean, it's like something like, if I'm not mistaken, like 19, 20, 21% or something on a credit card or overdraft. So that's like the short-term debt. So there's different kinds of debt, and they come at different prices. So, Pieter, maybe you can just kind of talk us through how you would approach, maybe from the worst debt out there, supposedly. Is it a decision? Is it a question? Invest or pay off debt, from going from the worst kind of debt, maybe up to the better, the good debt, as some people might say.
Yeah, sure. There's bad debt, there's neutral debt, and there's good debt. So bad debt, like you said, that's credit cards, overdrafts, personal loans. Some are regulated and some are even not regulated. If you go down these dark alleys in Joburg, you'll probably find some loan shark that give you money and they will charge you hundreds of percentage in interest, and store cards, stuff like that. So typically how we would like to compare that, just instead of just saying pay it off, the logic behind it is, let's say you have a credit card that's overdue and you know that you need to pay it off within the next 30 days. Now, an equivalent option to that would be to save my money somewhere. Now, you're not going to put an investment that has a 30-day period into the stock market. That's way too short. The equivalent of that would be keeping it in the bank, because you don't want any volatility. So the bank might give you 6 or 7% return if you put it in a bank savings account or maybe even a money market fund. But then you compare that to a credit card of 20%. That's very easy maths. Pay off the credit card, pay off the overdraft. So there's not even a competition there. Before you can even start thinking about investing for the long term, you have to kill off the bad debt. And that's probably in South Africa, I would say, my framework for that would be anything above 13%. You probably just want to get rid of, because even if you were to invest long term in the stock market, you'll be lucky to get that 13% and up after tax on stock market investments. And then we get the middle group, that's a neutral debt. So neutral debt in my eyes is something like a car loan, or maybe even a home loan that you live in, a primary residence. You need a car to get to work, and you need to stay somewhere. You need a roof over your head. So it's not bad in the sense that I can't buy this thing cash, I need to take out a loan. It becomes bad debt when you overextend yourself, when you buy too much car than what you can afford. I see it very often, young professionals, when they start working, they go and buy the most expensive car that they can afford by the dealership, which oftentimes mean that a lot of their cash flow goes into just paying off a car they don't actually need. And then that means that they can't invest money. And that's a huge opportunity cost for a young person. Equally with a house, the bank will again tell you what you can afford, but then oftentimes people get so crunched under debt payments, especially if the interest rate rises, that they are not able to invest anything. That then becomes bad debt, because it's inhibiting your ability to build wealth alongside paying off debt. Buying a good, fuel efficient, maybe secondhand car to get back and from to work, that's perfect. Buying a house to stay in, that's not outside of your means, is fine. So then that would be considered kind of like good debt. But then we get to good debt. So good debt would be considering using the bank's money to build wealth. So building out an investment property portfolio where you use a portion of your own money to maybe put down a deposit to buy a house, and then you refurbish it and it grows in value, and you refinance, you get equity out of that property, and then you go buy another property, and you kind of repeat this process. Then that's putting money back in your pocket, because you are renting out that property. It's cash flow positive, hopefully. And then that could be considered good debt. You're using it to your advantage. So the conversation comes to bad debt, you pay that off before investing. That's an easy one. Neutral debt is like primary residence, car loan. We will share a bit more how we go about choosing how to invest that. That becomes a very close call when it comes to paying off debt versus investing. And then good debt, usually it might actually make sense to focus on the debt more, depending on the structure that you are building out versus investing, because it all comes down to what option is going to put more money back into my pocket over the long term. And the term becomes very important. If we think about a 20-year loan on a house, then that we can compare to the stock market, because typically in the stock market, you would invest your money in equity ETFs that has a time horizon of 20 years. So then that after-tax return on the stock market needs to be compared to the after-tax interest, which essentially paying off debt is interest-free. And then that becomes the number of comparison. But then we also have to throw in the behavioral component, because a lot of the decisions we make around money is actually more behavioral driven than what it is about numbers. So that is kind of how we would unpack the three types of debts.
Yeah, thank you. So to like, if you want to summarize that, it would be short-term debt is like credit card and overdraft, where you're constantly servicing it and it has to be paid off quite quickly. And so that is going to be compared to a short-term investment. Short-term investments are basically just like savings accounts, money market accounts. And we know that that provides best case scenario money market over 1 year, which is about 7%. So that's very easy to understand. A long-term property repayment, so 20-year, 30-year maybe on a bond, compare that to a 20 or 30-year portfolio. And then it becomes a bit more interesting. And that's where it firstly, we can look at these kind of rules of thumb. I'm not a massive fan of rules of thumb. It's not a plan, but it definitely is like a starting point for a conversation. So you can look at something and say, immediately it looks like a good idea or a bad idea based on kind of collective wisdom from finance. But at the same time, you do need to apply it to your own circumstances. And so one of the rules of thumb you can kind of look at is what you alluded to at the end of your message now, which was comparing interest rates between the one and the other. So in South Africa, you might have a bond at 10%, a loan on your home, 10% repayment at the moment, but hopefully it's linked to the interest rate, so it'll go up and down. And so if it goes up and down, you think, okay, well, currently I know it's 10%. Over the long term, I might get 11, 12% a year in the markets, on a global ETF. If I'm getting 12% a year, 10% repayment on the interest on the home loan, it's quite close. There's still CGT to take off of the growth, capital gains tax to take off of the growth of the investment. You can do the math there, but it's starting to become quite equal. And so that is where you talked about, like, it's more a deeper conversation. And so, and more to consider. So rules of thumb kind of in South Africa, because of our high interest rates, they kind of cap out over there. But now something else that's important to consider is, does the property you have financed produce an income? In other words, is it an investment asset as opposed to a lifestyle asset? Because our homes that we live in, if they don't produce an income, it's not an investment, it's a lifestyle asset. And that's fine. Like if you have to go into debt to fund lifestyle asset, that's fine, because living life is all about having a nice lifestyle. So, you want to be happy in your home. But if you do have an investment property, now you got to treat it like a business. You got to treat it like you would at work when you're managing your division or your team or your budget. And you got to look at all the ins and outs. And so what we do is there's a rule that, and a formula that we will share in the show notes at the bottom of this video. We'll put it there for you with a bit of an example. This isn't gospel per se, but this is a good way of determining at face value if it's worthwhile settling the bond on that investment property before investing, or rather investing while, just servicing that bond. In other words, paying what you need to every month. And so I've got an example here, which we've kind of worked out here. So if your interest rate on your bond is, let's just say, for example, 10.5 on that rental property. And let's just say personally, a lot of our clients, their marginal tax rates are 41% or 45%. So let's just say your marginal tax rate is 41%. You want to now work out what the interest rate that you're paying on that bond is compared to a potential return on investment. So you might say, okay, well, 10.5%, that's quite high, and 11, 12% over 20 years in the markets. So once again, it's quite tough. But, the interest you earning, or the interest you're paying rather on the bond, is tax deductible. It's tax deductible against the income that you're earning. So you get more income. So effectively, the rate that you're paying is not 10.5%. If your marginal tax rate is 41%, there's a formula you apply. It's basically 1 minus 0.41. You get like 0.59. Multiply that by 10.5, and then you come up with about 6.2%. So like 6.2% is your effective interest rate on that bond. Because you're earning an income from it and someone else is helping you to pay off that bond and you're getting a tax deduction, it goes from 10.5 to 6.2. And now you might say, okay, so if it's like 6-ish% compared to what I might get in the markets over the same time, that's potentially 12% gross of tax. Then you can also apply the same thinking to like capital gains tax or something. You can work out the formula. Maybe we'll put that in the show notes for you as well. But you can already see it's now going to be, there's an arbitrage to be had there. And so that's the difference that you can unlock. So now you've got an investment, getting a tax deduction on the income on the investment. And now you're saying, fine, I can build up more capital elsewhere by investing money instead of nailing that debt for that property. So that's something we look at. Once again, it's not necessarily set in stone, but it is something that we'll look at and that will inform the next conversation. And so the next conversation we get from there, if we're sitting, if you my client, Pieter, and I'll say, fine, we've done the math. Maybe it makes sense to invest this money. Now, I'm going to ask you, Pieter, to rely on the conversations we've had with the clients that we serve. What do you find sometimes when like someone says, you show them all the math and it makes sense to invest and not pay down the debt? Do you find sometimes people are saying, yeah, I hear you, but no, I want to clop that debt?
Of course, living with debt comes with a lot of psychological factors. It's not, we are not designed to want to owe people things. We want to live a life that is simple, or at least the clients that we serve want to live a life that is simple and that a plan that's easy to follow. And oftentimes, especially I think as you get closer to retirement, that is a big shift now in your life, because you're going from I'm earning an active income to I need to draw from my investment portfolio. Now, earning an active income and paying off a bond may not sound that bad because there's an element of predictability. Like, okay, I can just earn money, or I can just earn more and I'll be okay if the interest rates rises. Once you start drawing an income from your investments, now the whole game changes, because now I am limited in how much I can draw down. Because now I get all of these other things I need to think about. If I draw down too much from my living annuity, there's that sequence of return risk, which means that if the markets drop, I might eat into my capital, which could have bad consequences 30 years from now. Something simple like if you are retired and you are not able to earn an income in the traditional sense, you might not even be able to get approved for a loan, even if you wanted to buy like a car. So that changes now. And also, when you want to earn a pension income and you have to continue to pay down a bond, it's quite a big chunk of your expenses that will go into that, which means you're going to have to draw down more from your investments, which means you also pay more taxes at that point in time. When you get to retirement, there's an option to take 1/3 out of your pension or your provident or your retirement annuity fund, and that might be able to you could use that to settle your bond. But there's also taxes there. There's retirement tax tables that get applied. And sure, the first 500 to 50,000 is tax-free. But what we typically want to understand is how much do we need to take out so that the after-tax amount of that lump sum is lower than what it would have been if we drew down a monthly income. And if you have a bond payment, that monthly income gets pushed up quite a lot, which means that it becomes a very tricky situation. So taxes starts to play a big role at that point in time. Now, if you are still 15 years away from that point where you have to decide how much to take out, it might actually make more sense for you psychologically to start paying off that bond, because you don't want to deal with that type of issues later on. And I just don't think anyone in retirement would want that necessarily, or not anyone. I'm sure there's a few that are fine with that, especially those that are following the property investing route and they've built the right structures for that in trust and companies, and they can play that game. But for most South Africans, the psychological benefits of not having any debt and having it all paid off at retirement, I think sometimes also outweighs just the numbers and the maths, because it's not always just about the numbers and maths. You might have the best mathematical equation in front of you, but if you can't sleep at night knowing the maths because the debt is like, especially now in times of war and uncertainty where interest rates may rise, even a 0.5% increase in interest rate can fundamentally change your lifestyle, because now you have to start cutting down other things because your bond is increasing. So I think what we oftentimes do is we will start with the numbers, the logical side, and explain, all right, this is option A, option B. Based on numbers, this is what we would typically go with. But what do you feel about this? How do you feel? What option seems right to you? And sometimes it's not just about the maths, it's also about the psychology. And I think a lot of the content internationally, especially like Dave Ramsey as an example, American content creator, he's very much fixated on paying off debt as early as possible, regardless of what the numbers say, even like never taking out credit cards. He goes quite to the extreme end with that. And I think that's because he has followed a similar route of building property portfolios, having a lot of debt, leveraging it, and going bankrupt. And he's been working with many people, like hundreds of thousands of people over his career. And he saw that the biggest stumbling block for a lot of people to building wealth is just having debt. So that is why he enforces the opinion he has based on experience he's seen on the behavior side of money. And I think that we always need to think about that before we make any decision, because we also need to live a happy life, which doesn't just get fixated on the numbers. It also goes about the emotional side of the decisions we make.
Thanks. I'm glad you mentioned that, because the emotional side, because it's personal finance, it's personal to you. And so with personal finance, whatever your kind of values are, whatever your like emotional triggers are in that's going to kind of help determine which way you go in life and what advice works for you. And so these rules of thumb, it's nice to start the conversation, but it's not a plan and it's not gospel. And so if anyone is listening to this and you're reading personal finance books, you're on personal finance forums, just remember, nobody knows you. So, they might say, oh, I would do this, I would do that. Well, that's what they would do. But is that best for them? Like, for example, you might say, I've got no money outside of a retirement fund. I've got all my money in a retirement fund. And we find this all the time. I mean, this week I'm starting to work with a new client, worked for one company, executive at a very large multinational firm, worked for one company for 20 odd years, many millions in a provident fund, like many millions. I can already see a problem on the estate, and we haven't started working together really yet. I just got a snapshot of the estate. There's no money outside of the provident fund. Okay. So now it's like 7 or 8 years to retirement, no money outside of the provident fund, and there's a bond, a home loan of like 3 million. Now, this is a scenario that we do with clients all the time. So in the next episode, what I will do is I will run you through the viewers and listeners, a case study that we worked on with our clients who have this scenario where there's lots of money in retirement fund, between 5, 7 or so years away from retirement, and there's still a mortgage, there's still a bond, a home loan that needs to be paid off. And you can see coming to retirement, there's going to have to be this liquidity event. You're going to have to take out tons of money from your pension fund to pay off that bond. And so you might go onto a personal finance forum and post that scenario there, and people will say, start building up liquidity. So start taking all the extra money you got and invest it. You might be surprised by the outcome, because no one's taking into account tax, and the tax you will pay from the retirement fund to pay off that bond at retirement, whatever's left, 1 million, 2 million, 3 million. So we will unpack that in the next episode. And that is why personal finance, I say, is personal. So you look at the states, and you mentioned Dave Ramsey, Pieter, and you mentioned a few other things you've seen online about leveraging, and leveraging means, borrowing money and then investing it. Now, that does work in some countries. I think it works well in the US. I think it can work well in the UK and Europe. It doesn't work well in South Africa. And so I wanted to spend one little portion of this call now, or this recording, explaining that, because in the US they have low interest rates, but the stock market still provides them with good returns. So last time I looked, I think in dollars over the long term, I think 15 years, the S&P 500 gave Americans something like 9% a year or something like that in dollars. They're paying probably half of that on a repayment on the interest for a long-term loan. So like 4 or something, 4% or something. So
Yes.
you can see there's a massive arbitrage opportunity of 5%. So if you can service that debt while you're letting this money grow, you get this windfall that after 10, 20 years, you get a lot of money. In South Africa, it's too close. Our interest rates are too high. So it doesn't necessarily work. But I do hear people have that conversation. And we've had some clients or prospective clients reach out to us talking about doing that. It's not necessarily something that applies universally. And that comes back to your point, where the general rules and the mathematics say do this, but personally what works for you in your circumstance, in your job, where you are right now in life, it doesn't always translate. It's not a universal truth. There are things that are just specific to you. So that's, I don't want to kind of flog this one to death, but I think in general, you can invest and pay off debt. If the interest is too high on the debt, you want to get that down as soon as possible, because it's going to undermine your whole financial plan. As we wrap up, Peter, anything else that I've forgotten, you've forgotten, that you still want to add?
I think at the end of the day, like comparing apples versus apples comes down to a lot of nuances that you need to think about. Think about like paying off debt. That is always going to be a guaranteed return. If you pay 10% interest and you pay extra, that's almost like getting a 10% return, because you are paying 10% less. If we say the stock market has given 12% per year, that is on average over a long time period. That doesn't mean every year it's 12%. Some years it might be 40%, other years it might be minus 20%. So that's that guaranteed aspect of it. And then the taxation. So paying off interest is not a taxable event, so there's no taxes. And investing in the stock market could be tax-free if it's in a tax-free savings account or retirement annuity, pension fund, those things. But if it's in a normal taxable discretionary investment, we always need to think about the after-tax amount. And that depends on what are we investing in. Is it just pure equities? Then it's capital gains. If it's in dividend-paying stocks, it might be capital gains and dividends. If it's just in the bank, it's interest. Then we think about our marginal tax rate. So this is how these equations kind of need to start getting unpacked, and where it does get a little bit more granular if you want to get to like a specific apples versus apples comparison. And there would be people that have built successful investment property portfolios, but typically that won't necessarily be in your personal name. That's typically not a good idea, because we don't want to hijack this whole episode in investing in property versus the stock market. But in those cases, it's probably best to use different structures like trust and property companies, where you move that debt out of your personal name into a different structure, so that you don't have to live with that stress in your personal capacity, where if everything goes down, creditors may come and take your house and your cars, your personal stuff. So that's a different conversation. So we probably have to make a separate episode on that to compare that type of strategy to this. What we typically, clients we work with are more so, you've bought a primary residence and maybe one or two investment properties in your own name that you have to decide, do I pay off extra, do I not? And there's never a one size fits all. We have to think about all of these different little elements combined, and then decide, all right, for me, mathematically, emotionally, psychologically, it makes more sense to do this, to follow this route or that route. And I think that's where educating yourself becomes important, especially because there's so many great online sources to learn from. Just be careful not to follow absolute opinions, and always ask yourself, what is the narrative that is being driven by the content you consume? Because if someone talks about maybe not ever putting extra money into the bond and just investing in the stock market, maybe they've got some sort of service they sell investing in the stock market. Or maybe it's someone that says, don't invest in stock market, pay off your bond. Maybe they're a bank or something. I don't know. So just be careful what you consume. And learn enough so you can filter good or bad. But when it comes to these big decisions where it could fundamentally change and potentially there's the opportunities cost of the side and also the taxation side, where the magnitude of your decision is very big, it also helps to get good advice on that specific scenario, taking everything into account. Because we oftentimes have to zoom out, look at everything, and then zoom back in to then make an informed decision after we understand your full scenario quantitatively, or the numbers, and qualitatively how you think about money, how you've been brought up. What was your situation at home when you grew up? Was there a lot of debt? Was there a lot of stress? Because that could fundamentally change your own perception on how you decide to work with money one day. So we've probably only scratched the surface today on this conversation. It's a very interesting one to have, and there's so many ways that so many different directions you can go about it. But hopefully what we've done today is just to help you understand the big things to think about, and to then help you hopefully make a good informed decision once you are at that point in time.
Great. Well, thanks for that. I can't add anything to that excepting look out for the next episode. We go through the case study, and hopefully that scenario resonates with you and it adds tons of value. Have a good one. Thanks very much.
Cheers.